the second or third method to analyze the riskiness of cash flow. Then we'll move on to chapter 15, capital structure, which is the last chapter that will be covered in this semester. So there are 5 steps to conduct the project, right? So first step is to we estimate cash flow stream. Second step is to analyze the riskiness of cash flow stream. Third step is cost of capital. We can calculate the cost of capital. Fourth step is we need to use the methodology to make decision whether or not we accept the project, such as MPV, IRR, MIRR, IIRR, payback period, just like that. And finally, in final step, we can make the decision. Okay, so we have done to talk about third, fourth, fifth, and first step, and we are here now. So there are 3 methodologies to analyze the riskiness of cash flow stream. First one is sensitivity analysis. Second one is scenario analysis. Third one is Monte Carlo simulation. Okay, so we talked about sensitivity analysis in last class. So in sensitivity analysis, we changed only one variable and other variables are fixed as the original our expectation. Then we can figure out which variable is the most sensitive with respect to net present value. Once we figure out the most sensitive variable, then we should recalculate those kind of forecast expectation value of that variable, right? That's the sensitivity analysis. Scenario analysis is similar to the sensitive analysis, but the different thing comparing to the sensitivity analysis is that we can change all of the variables with the same direction with respect to net present value in scenario analysis. So the scenario analysis is a risk analysis in which bad and good sets are compared with the most likely situation. Most likely situation is base case scenario. Yeah, when we use the original assumption of the value on each variable, that's gonna be base case scenario. So input variables are set at most likely values. That's gonna be base case scenario. So we already figured out 78 point some dollars, $82, something like that, for the project S, right? And the best, so we will consider three kind of scenario. Base case scenario that we have already done. Worst case scenario is that we can change all of the input variable just like the same direction with the worst case, the negative direction, negative way, right? So the worst case scenario is at worst reasonable forecasted value. Whereas best case scenario means that we assume that the value of each variable change to move to the positive way, positive direction simultaneously. That's the at best reasonable forecasted values. So if we assume that all variables change to positive way, and then by using that assumptions, if we when we calculate the net present value, that's gonna be best case scenario, right? So here you go. if you take a look at the page number 488, 488, figure 13.2, 488, figure 13.2. So just like that, we have 6 variables, right? Sales price, variable cost, fixed cost, others, units sold, WACC, just like that, right? What's another one? Last one, equipment, right? Price of equipment. So in the sensitive analysis, we change only one variable, such as the sales price may move on $2.5 from $2. Original assumption is $2, but if we expect the positive way, sales price increase to $2.5 if 25% up, right? In that case, other variables are constant, right? Fixed as the original value. Okay, that's the sensitive analysis. But the scenario analysis is just like that. We assume that all the variables change the same direction to the net present value, such as sales price increase, then it's good to the company, right? But the good influence to the net present value. Variable cost decrease, fixed cost decrease, unit sales increase, WACC decrease, equipment price decrease. So these 6 variables change following this direction simultaneously, then we would say that's the best case scenario. If those variables change just like that, then we can calculate the net present value, which is the best, right? Best at net present value. So that's the best case scenario. Whereas if sales price decrease, variable cost increase, fixed cost increase, units sold decrease, WACC increase, equipment price increase, that's gonna be that affect the bad thing, right? To bad affect the decreasing the net present value. That's the worst case scenario. So if we assume those kind of variables change the value just like the negative way simultaneously, and then if we calculate the net present value, that's gonna be worst case scenario. Okay, so if you take a look at the figure 13.2, here you go. This is the sensitive analysis. So in that case, if the value of each variable are fixed as our original expectation, that's gonna be $78.82 for that present value, right? But if the sales price goes up 25%, which means to $2.5 from $2, then that present value increase just like that one, right? That's the sensitivity analysis. Scenario analysis is just like that. So this base case scenario is we already figured out, right? So the minus $1,000. If we spend the $1,000 as capital expenditure and the working capital increase, then we can generate the $500 at time 1, $400 at time 2, $300 at time 3, $100 at time 4. So WACC, because WACC 10%, we calculated $78.82 for a net present value, right? But what if all of the variables change to move to the positive way, with respect to the net present value, which means sales price goes up 25%. The equipment goes down 25%. Equipment price goes down 25%. variable cost goes down 25%, fixed cost goes down 25%, unit sold goes up 25%. Then cash flow stream is gonna be changed definitely, right? So if the each variable value are just like that, then we can expect the $2,685 at time one, 2,520 at time two, 2,3,590 at time three, 2,135 at time four, right? So cash flow stream that are expected to be occurred in each year is going to be changed, just like that. And furthermore, WACC is going to be decreased because WACC should move to the positive way with respect to net present value. So WACC should decrease the 7.5% from 10%, right? 25%, the up, I mean the 25%, and if we set the range of 25 plus minus 25%, right? So the WACC decreased 7.5%. Of course, the total amount that we spend is decreased to $750 from the $1,000 because the equipment price is going to be decreased. Okay, so if we calculate this kind of cash flow stream with the WACC as discount rate, then the present value goes up to the 7,000 something. Wow. This is the 100 times rather than our original net present value, right? So if all of the variables change, the 25% of our original value, original assumption to the 25% the positive way, then simultaneously, all of the variables change simultaneously to the positive way as much as 25%, then net present value goes up about 100 times rather than our expectation. Whereas if the variables change to the negative way simultaneously as much as 25%, then the cash flow stream is going to be changed just like that. Definitely WACC is going to be increased to 12.5%. Then the present value decrease negative $4,782.4, right? So, in scenario analysis, we can separate the steps. Four steps, right? First step is what we can calculate the net present value of each scenario, right? So we already figured out the base case NPV in base case scenario, and we can calculate the best NPV in best case scenario and NPV in worst case scenario, right? That's the first step in the scenario analysis. Then that's gonna be 7,000 for the something, 7,8 something, negative for something, and then we can set the probability that each case occur. Okay, so definitely the probability that base case scenario realized occurred is the highest, right? So we set 50% of probability that the base case scenario can happen, right? And the left-hand side is the worst case. Right-hand side is the best case. So in each case, we can allocate 25% of the probability. 25%, 50%, 25%, right? So this is best case, base case, worst case. It depends on your, judge. So, definitely the base case, the probability that the base case scenario is realized, is happened, is the highest, right? 50%. and we can allocate the 25% on best case and worst case in each case, right? So 25%, 50%, 25%. Then second step is what? We need to calculate the expected net present value with those three scenarios. Okay, so how can you get the expected net present value with these three scenarios? $78.82 times 50%, 7450 times 25% plus negative $4,782.4 times 25% is gonna be expected net present value is $706.4. All right, that's the second step. Okay, and then also we need to calculate the standard deviation. Standard deviation. It's a 4,370.24. How can you get this one? This is the just by your hand, right? So expect average 706.4 minus 7450.38 square times 0.25, right? Plus 706.4 minus 78.82 square times 0.5 plus 706.4 minus 4782.4 square times 0.25 and square root is gonna be 4,370.24. And then the third step is what? We can calculate the CV, coefficient of variation. All of procedure so far is to calculate the coefficient of variation. As you know, coefficient of variation we already figured out. Coefficient of variation can be calculated by standard deviation divided by expected net present value. So 6.19 can be calculated by 4370.24 divided by 406.4. So that's the 6.19. That's the coefficient of variation of this specific project. That's the third step. And then finally, what should we do? So the first step is in scenario analysis, first step, we can calculate the net present value on each scenario. What if all of the variables change to move on the best case, positive way, up to the 25%? And we also think about the worst case. And all of the variables change the negative way up to the 25%. Then we can calculate the net present value in best case scenario, net present value, and worst case scenario. Then second step is what? We can calculate the expected net present value. How can we get 706.4? This one times 25%. This one times 50%. This one times 25%. So 1 plus 2 plus 3 is going to be 706.4. And how can you calculate the standard deviation of the present value? 706.4 minus 7450 square times 0.25 plus 706.4 minus 79 square times 0.5 plus 706.4 minus 74782. Right? This is plus, right? Plus square times 0.25 5 square root is going to be 4370.2. So coefficient of variation is going to be 6.19. Okay, so this specific project S, coefficient variation of this project S is 6.19, right? This is the third step. And finally, why we calculated the CV of this specific project? Because we need to consider whether or not we should adjust the riskiness of this cash flow stream. Okay, so here you go. If the company's average project has a CV of 2.0, then this project is riskier, right? This project CV project S is 6.19, but the CV of average project conducted by this company is only 2. Then which is riskier? Definitely 나해. Which project is riskier? Project S or average project?
S.
Exactly. 있잖아. This project is riskier. 이랬죠? Right? So project S is riskier than project A, right? Then we should adjust. Perhaps some sort of risk correction is required for proper analysis. Okay, so if the project sees the CV 6.19, but the project conducted average CV of projects conducted by this company is only 2, then this expected net present value, the probability of this expected net present value is not perfect, right? So the probability this expected net present value is realized is very low. So real net present value is definitely lower than this expected net present value. Lower than this one, lower than this one, lower than this one, because this project is riskier than the average project conducted by the same company. So we need to decrease of net present value comparing to the original value. How come? Most convenient way is what? We can increase the WACC. So the most popular correction method is to change the WACC. So specific project is riskier than the average project conducted by the same company, then we should increase the WACC, then net present value should be decreased, right? On the other hand, if the project CV of this specific project is lower than CV of the projects conducted by the same company, then we can decrease WACC that affect the increase in net present value. Right? So by using scenario analysis, so the final purpose is different, right? So the purpose for the sensitive analysis is to recalculate the most sensitive variable, okay? But the purpose of scenario analysis is to change the net present value by using some risk correction. If that project's CV riskiness is higher than the average project riskiness conducted by the same company, right? So purpose is different in the scenario analysis and sensitive analysis. Okay, so we should increase WACC that affect the decreased net present value because this project is riskier than the average project conducted by the company, right? That's the scenario analysis, second way, right? Scenario analysis. And third way to estimate the riskiness of cash flow stream is Monte Carlo simulation, Monte Carlo. So as you expect, this is the sort of Monte Carlo, so the name of Monte Carlo, right? The region name, Monte Carlo. So this is the, as you expect, this is sort of the casino gambling. This is simulation. So Monte Carlo simulation is a risk analysis in which probable future events are simulated on a computer, generating estimated rate of return and risk indexes. So analysis of the effect in changes of several variables simultaneously, but this is more complex. So just like that one, so we are considering 6 variables, input variables, right? Sales price, sales unit, variable cost, fixed cost, equipment, and the last one, WACC. We are considering 6 variables, right? So sensitive analysis is what? We can change only one variable. Other variables are fixed, okay? And then we can figure out the most sensitive variable. Then we need to calculate the variable's value. That's the sensitive analysis. And the scenario analysis is what? We can calculate the base case scenario, net present value, and if sales price, if best case scenario, up, up, down, 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 down. Worst case scenario, down, down, up, 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 up. For example, 25% or 25%, right? And then you can calculate the expected net present value and then CV. Then by comparing the CV of the specific project and the CV of the average project, we need to adjust the risk correction, right? That's the sensitive analysis, the scenario analysis. So simultaneous change. Monte Carlo simulation is just like that. First of all, you can set the change of range on each variable. So it's like sales price change to 1.5 to $2.5, right? Fixed cost change to $1,500 to the $2,500. Plus, if we consider plus minus 25% of original our value, WACC is 7.5% to 12.5%. Okay. Once you set the range of each variable, then Monte Carlo simulation is what? Computer select each value, just like 1.8, 2,214, 11.4%. So computer choose a specific value within the range of each variable. Then you can calculate what? Net present value with this input data. So just like the scenario analysis, all of the variables are changed, right? But the not go to the same direction. Some variable go to the positive way, some variables go to change the negative way. So just we can calculate the net present value first. If we do this kind of thing 10 times, 100 times, 1,000 times, not by you, but by computer, 1,000 times. So second times, So we can calculate that present value is 782. If we change the, just like the variables value, then the second one is the 2024. If we calculate the third time, this is a negative 11. Fourth time, fifth time, sixth time, 100 times, 1000 times, then this is a central limit theorem. Central limit theorem means what? If we have the lot of the observations, then we can get the average, right? So if we have the 3 observations, just like 7, 8, 2000 minus 1000. So there's very, the wide range. But if we do this kind of work again and again, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 14, 13, 14, 16, 17, 17, 18, 19, 100 times, it's this connection still 200 times, 300 times, then even if there's some outlier, right? But if we calculate the average, then this is converge to the average, That's the central limit theorem. So if we have a lot of the observations, then we can figure out the average. Okay, that's the logic of Monte Carlo simulation. So if we calculate the average of net present value with 1,000 times or 10,000 times, then we can get the logical value as average. That net present value can be used. That is the Monte Carlo simulation. Okay. So if you take a look at the page number 489, Monte Carlo simulation. So, 안경을 안 벗었구나. So Monte Carlo simulation, so named because this type of analysis grew up of work on the mathematics of casino gambling. So according to some theory, the MIT student go to the casino, then they can use this kind of the methodology, then they can make the profit, right? Okay. So the casino gambling also is a sophisticated version of scenario analysis. So we would say Monte Carlo simulation is a sophisticated version of scenario analysis. Here the project is analyzed under a large number of scenarios or runs. In the first run, the computer randomly picks a value for each variable, units sold, sales price, variable cost per unit, and so forth. Those values are then used to calculate on net present value, and that net present value is stored in the computer's memory. Next, the second set of input values is selected at random, and a second net present value is calculated. This process is repeated perhaps 1,000 times, 1 million, or not 10,000 times, then generating 1,000 net present values. The mean of the 1,000 net present values is determined and used as measure of the project expected net present value, expected profitability. And the standard deviation of the net present values is used as measure of risk. The Monte Carlo simulation is technically more complex than scenario analysis. It's common, right? 1,000 times. But simulation software makes the process meaningful. Simulation is useful, but because of the complexity, a detailed discussion is best left for advanced finance courses. Okay, so at the financial management class, just I let you know basic logic of Monte Carlo simulation. So, but fortunately, we can calculate the Monte Carlo simulation. We can do the Monte Carlo simulation by using Excel spreadsheet, just like that one. Sorry about this is the Korean, right? So this is the sort of Monte Carlo simulation result. Okay, so there's the function key of run. So table table. Anyway, so in this case, in this course, I won't explain the how can we use the Excel spreadsheet if you want to the Monte Carlo simulation. But what you should know is that you can use the Excel spreadsheet to do the Monte Carlo simulation. But it's a little bit complicated, so I won't explain that one. Anyway, we can use the Excel spreadsheet to do to get the solution of Monte Carlo simulation. All right. So that's the Monte Carlo simulation. So we had talked about three kinds of the method to analyze the riskiness of the cash flow stream. Okay, the sensitive analysis, scenario analysis, and Monte Carlo simulation. Right? Okay. Any questions so far? All right. Then if we do not have any question, then let's take a look at the last topic of this chapter. So last topic is what if? What happened if two projects have the different life cycle, different life period. Okay, so this is a different project. So let's take a look at two projects, Project C and Project F. Project C has the 6 years life, whereas Project F is the 3 years life. Okay, so Project C, total amount of the capital expenditure is 40K in Project C, and you can anticipate the 8K at the end of first year, 14K at the end of second year, 13K at the end of third year, blah blah blah. Then we can calculate, if we calculate the net present value for Project C, that's gonna be 6,491, right? Whereas Project F has a 3 years project life. So the total amount of capital expenditure is less than Project C, which is 20K. And at the end of first year, we can forecast the 7K, at second year 13K, at third year 12K. So if we calculate the net present value for Project F, it's the 5,155. Okay. Then based on this the result, which project is better? Which project is better? Definitely project. Which project is better? Project the one. Which project is better? Project C or Project F? Project
C.
C. Project C is better than Project F because Project C is the anticipated as much as 6,491, whereas Project F is 5,155. So based on this calculation, we should select Project C, which may be wrong. Which is more likely to be wrong? Why? if two projects have the different, just like huge different life, then we need to make equal two project life equal. Okay, by using the least common multiple. 이 뭐야? 최소 공배수. 최소 공배수. In Korean, the least common multiple. So if two project life is one of them is 4 years, the other one is 7 years, then the least common multiple is 21 years, right? Or 6 years, 4 years, 12 years, right? 최소 공배수, the least common multiple. So in this case, one of them, project C is the 6 years duration. Project F is 3 years. So the least common multiple is 6 years, right? So we need to expand project F's life to the 6 years from 3 years. But this condition should be satisfied. The condition is this project will be repeated, can be repeated. So to use the least common multiple, the basic condition is that project can be repeated. That condition should be satisfied. Okay, so we can, if we extend this project F once again, then we have two methodologies to analyze with a different life. First one is replacement chain method. Second one is equivalent annual annuity. So replacement chain means what? Use the replacement chain to calculate an extended net present value for project F to common life. Right? So this is 6 years. So project F is 3 years. Project C is 6 years. So project F extend project F's life to the common life, which means 6 years, right? From the 3 years. So since project F has 3 years life and C has 6 years, the common life 6 years. So we can assume that project F can be repeated. So negative 20K, 7K, 30K, and 12K, this project cash flow stream can be repeated from 3rd year to the 4th year, 6th year. Okay, this is the repeat again. Then the total cash flow stream is negative 20K, 7K, 13K, and at time 3, negative 8K, 7K, 13K, 12K. It's a new cash flow stream. Okay, so this cash flow stream can be repeated, assumed to be repeated. Then with this kind of cash flow stream, then if we calculate the present value, then the present value for project F is now 8,824 on extended basis. Now, if we compare net present value for project F and net present value of project C, net present value of project C is 6491. Now, which one is better? Project C or project F? 동환.
Project
Now,
F.
which one? Yeah, now which one is better?
Project F is better.
Yeah, project F is better. 뭐 이랬다 저랬다 해. So project C. So when we think about by using the original information, project C was better than project F. But if we assume that this cash flow stream can be repeated again, then project F is better than project C. So our decision is going to be changed, right? So, if two projects have the different life, then we should we should make the duration equal each other, right? That's the first method, which is a replacement chain. Or we may use equivalent annual annuity, the second method, to make the life equals. So EAA, equivalent annual annuity. Let's take a look at the basic concept first. Using the previously solved for the project net present values, the EAA, equivalent annual annuity, is the annual payment that the project would provide if it were an annuity. So we assume that we receive the annuity. And the basic concept of annuity is what? We can receive the identical same amount on each year. That's the annuity, right? Same identical amount, right? So project C has 6-year life. 1, 2, 3, 4, 5, 6. Project F has the 3 years maturity, right? 3 years maturity. So project C's net present value is negative 6491 and 6491. F is the 5155 in original. By using original information, right? Project C's net present value is 6,491. Project F's net present value is 5,155. Okay. Then we can consider this one is the annuity, annual annuity, right? So this is the net present value means the current value cash outflow. So this is gonna be negative. Then how much money we can receive during 6 years? How much money during we can receive a year during next 3 years? That's the annual annuity, right? Equivalent annual annuity. So if we can, there is the concept of the payment. When we talk about the time value of money, you're familiar with payment, right? So payment is same amount, right? Same amount we can receive. So the project, we can analyze the project, which project is better by using this kind of payment logic. Okay, so if the present value is 6,491, if we receive the 6,491 during next 6 years, WACC is 12%. 12%. We should have this the assumption of 12%. Then we will receive $1,579 on each year. So payment is 1579, 1579, 1579, 1579. The fact that we have 6,491 as of today for 6 years project, then we can receive $1,579 per year on every year during the next 6 years. How about the project F? We can receive 2146, 2146, 2146. So during the next 3 years, the amount that we will receive is 2,146 years. So if we compare this payment, 2146, 1579 payment or annuity, which one is better? F is better than C. Okay, so we may use replacement chain to make the the life equals, or we may also use equivalent annual annuity. Okay, if two projects have different life, right? That's the solution if the two projects have different life, right? Any question? Yep. 그죠? 그러니까 아니 그렇게 보면 되지. 우리가 6,400 현재 가치 6,491이야. C는 현재 가치 5,155. 똑같은 거야. 우리 페이먼 하는 것처럼 6,491을 6년 동안 1년당 얼마씩 받느냐? 5,155를 3년당 1년당 3년 동안 1년당 얼마씩 받느냐? 그거잖아. Sorry about that is in Korean. So your colleague asked, how can we interpret this 6491 or 5155? So I told you, you can interpret that how much money you can receive per year during the next 6 years with the 6491, or how much money you can receive per every year during the next 3 years with the 5155. Right? Any other question? Nothing? Then let's go to the last chapter, chapter 15. Oops, 이거 아니다. Okay, chapter 15, capital structure and leverage. Can you see? Right, so capital structure. So I already explained the capital basic concept of basic concept of the capital structure when we talk about the cost of capital, right? Cost of capital. Wait. So capital structure and leverage. So in this chapter, we will talk about the 4 topics. First one is the which weight should be used: book value weight, market value weight, or target value weight. You already know the answer: target value weight, right? So when we talk about the cost of capital, I already let you know. And second issue is business risk versus financial risk. So we will talk about the 2 risk types from the point of corporation. And third one is we will figure out optimal capital structure. Optimal capital structure, as you know, that the capital structure that makes the to maximize the firm's value. So as I told you, each company has its own optimal capital structure. So we can figure out the optimal capital structure, which is very interesting but a little bit complicated, which means those kind of things can be appeared in the final exam. Okay, and the last one is capital structure theory. There are tons of capital the structure theory, just like the asset pricing model. But at financial management level, we only talk about the CAPM, right? Capital asset pricing model, just like that. We only think about the MM. MM is not chocolate name, and chocolate name, chocolate name, Modigliani and Miller, and trade-off theory. That's it. So if you are interested in the more capital structure, then you can take not investment, but corporate finance. Corporate finance. Taught by Professor Chen, Jingu Chen, Chen Jingu, Professor Chen Jingu. So in more detail, like corporate finance can cover the more detailed capital structure theory. So as I told you, I will try to finish up all of these contents by next Thursday. But if I cannot do that, then we will have the supplement class on December 7th, right? Okay, then which one is which weight should be used? Target weight. So the capital structure, what is capital structure? What is the optimal capital structure? What is client capital structure? We already figured out, right? Capital structure is percentage of each type of investor supplied capital. So capital structure, so what percent of the, common stock, what percent of preferred stock, what percent of the bond? That's the capital structure. So this is the current capital structure, as I told you, current capital structure. And all of the company, each company has its own optimal capital structure, right? Optimal capital structure that makes to maximize the firm values. The optimal capital structure, the firm's capital structure maximizes its stock's intrinsic value, as you shall see. And target capital structure is in the midst between current capital structure and optimal capital structure. So as I told you, target capital structure is the portion of each component to raise a new fund to get the optimal capital structure from current capital structure, right? From current capital structure to the optimal capital structure, if you raise a new fund, then what percent new fund can be raised by common stock? What percent should be raised by preferred stock? What percent should be raised by using bond? That's the target capital structure. Okay, so this is the Yama. This is essential. Okay, so when we think about the capital structure, when we think about the weight to calculate something, we should use the target weight. Okay, target weight is the essential target weight, not current capital structure weight, not optimal capital structure weight. Target weight is the essential, all right, to raise a fund. So let's take a look at the business risk and financial risk. If you take a look at page number 539, in chapter 8, we examined risk from the viewpoint of individual investors. So from the point of the investor, we can think about the diversifiable risk and the systematic risk, right? Systematic risk is same as market risk or the non-diversifiable risk, okay? So we distinguish the systematic risk from the total risk. So the total risk can be decomposed into systematic risk and the diversifiable risk. So the reason why we construct portfolio is to decrease the eliminate the diversifiable risk, right? So from the point of the investor, we thought about those kind of risks. And in chapter 13, we examined also risk from the viewpoint of corporation, and we considered how capital budgeting decision affect the firm's riskiness. So we already think about the risk when we talk about capital budgeting. Now, we introduce two new dimensions of risk. So a different dimension. The different dimension differentiate with what we talked about so far. So one of them is business risk. The other one is financial risk. Business risk, which is the riskiness of the firm's assets if no debt is used. No debt companies risk, as assess risk, firms assess risk. Whereas financial risk, which is the additional risk placed on the common stockholders as a result of using debt. Okay, so whether or not we use the debt, okay, that's the business risk and financial risk. Business risk is inherent risk of the company. Financial risk is the additional risk if the company use debt, additional risk. Okay, so this business risk and financial risk. So if the company doesn't have any debt, then we don't have to think about the financial risk. Okay, so we only think about the business risk. Okay, so let's take a look at the in more detail. So business risk. Business risk is a riskiness inherent in the firm's operations if it uses no debt. If it uses no debts, the riskiness inherent in the firm's operations. In reality, it's possible, no debt. In the past, it's almost impossible. All of the companies have the debt. But now this is possible in reality. For example, Samsung Electronics doesn't have any debt. Because why? There are a lot of the money within the company, right? There are tons of money within the company. Semiconductor. So nowadays, as you know, it's very crisis, not enough, insufficient semiconductor, right? So to produce some the car or something like that. So it's semiconductor market is now is very very how to say very the profitable market now. Okay, so the Samsung Electronics doesn't have any debt now. It's possible in reality, no debt company. And how can you calculate the business risk? Standard deviation of firm's return on invested capital or standard deviation of ROIC, the same meaning, right? So if you take a look at the page number 540, business risk is the single most important determinant of capital structure, and it represents the amount of risk that is inherent in the firm's operations. So the commonly used measure of business risk is standard deviation of the firm's return on invested capital. So standard deviation of firm's return on invested capital. Firm's return on invested capital. What's that? Return on this one is what? ROIC. Return on invested capital. Okay. So ROIC, return on invested capital, can be calculated by in the page number 540, EBIT times 1 minus T divided by total invested capital. So EBIT times 1 minus T is named as NOPAT, net operating profit of tax. So ROIC is the NOPAT with respect to the portion of NOPAT with respect to total invested capital. This is ROIC. So the business risk can be measured of standard deviation of ROIC. Okay, so standard deviation of ROIC is the can be measured as business risk. Business risk. Okay. Then what kind of factor to affect the business risk? Factors that affect the business risk: competition, demand, variability, sales price variability, input cost variability, product obsolescence, foreign risk exposure, operating leverage, just like that. Both of them, all of them, if the competition, the market is competitive, then the business risk is increased. So if you take a look at the 541, page number 541, competition, if a firm has a monopoly on a necessary product, it will have a little risk from competition and thus have stable sales and sales price, right? So if the market is competitive, then business risk is increased. It's common. And next page, demand variability. If the demand variability is high, if sales price variability high, input cost variability high, then the business risk increase, right? So all of things are positively related to the business risk. All right. How about the product obsolescence? So if product forms in high-tech industries like pharmacy and IT depends on constant stream of new products, the faster is product become obsolete, the greater a firm's business risk. So if the product obsolescence, degree of our product obsolescence is increased, then the business risk is also increased. Foreign risk exposure increase, then business risk is definitely increased. And important thing is the operating leverage. What is operating leverage? Anyway, operating leverage is increased, then business risk is increased. What is operating leverage? Portion of fixed cost out of total cost. There are two costs, right? Fixed cost and variable cost. Total cost can be decomposed of variable cost and the fixed cost, right? So the operating leverage means the fixed cost divided by total cost. So what is portion of fixed cost out of total cost? So the portion of fixed cost is higher, then we'll say that this operating leverage is higher, which affect the business risk. Okay, so let's take a look at the operating leverage more detail. Operating leverage is the extent to which fixed costs are used in a firm's operation. So the fixed cost divided by total cost. This is operating leverage. The higher a firm's fixed cost, the higher is operating leverage. Right? So if you take a look at the operating leverage, the relationship between operating leverage and business risk, the higher firm's operating leverage, the higher is fixed the business risk. If this ratio is increased, operating leverage is increased. If operating leverage is increased, then business risk is increased. Right? How come? Let's take a look at this graph. So effect of operating leverage. More operating leverage lead to more business risk. Right? How come? For that, a small sales decline causes a big profit decline. Okay, so operating break-even point. You've heard about break-even point, right? If you take the operation management, this is very, very basic knowledge. Break-even point. Break-even point means what? There's no loss and no gain, no profit and no the loss. The point. That's the break-even point, which means output at EBIT equal to 0, right? There's no when the no profit, no loss. So the break-even point is what? How many product we should produce to make the zero profit. That's the break-even point. So break-even point can be calculated by the EBIT equal to 0. That the EBIT can be calculated by PQ minus VQ minus F. P in a price per unit, Q is the quantity, V is the VC per unit, Q is the quantity, F is the fixed cost. So the quantity for the break-even point can be calculated by FC divided by P minus V. Let me show you. So break-even point. You heard about this concept, right? Break-even point is the EBIT equal to 0. So EBIT can be calculated by P times Q minus VC times Q minus FC. P is the price per unit, right? Price per unit. Q is quantity. V is the variable cost per unit, quantity minus fixed cost. So break-even point is the quantity that makes EBIT equal to 0, right? 0. PQ minus VCQ minus FC. So this is a Q times P minus VC. If we move the fixed cost to left-hand side from the right-hand side, then Q equal to FC divided by P minus VC. So the quantity that makes EBIT equal to 0 can be calculated by FC divided by P minus VC. This is the, Q equal FC divided by P minus VC. This is the quantity. Now, for your convenience, the left-hand side graph called A, and right-hand side is B, name B, for example. Then, this line is revenue. This line is revenue. This line is total cost. Below line is total cost. Above line is revenue. Okay, which means yellow range, yellow area display loss because the cost is higher than revenue, right? If you take a look at the light blue region, light blue area, revenue is higher than the cost. So this is the profit, right? So the light blue display is the light blue regions area display the profit, whereas the yellow region display the loss, right? Yellow region displays the loss, right? Then only difference between A and B is the fixed cost. This is total cost. Fixed cost of in A is as much as this one. Fixed cost in B is this one, right? So we would say B, operating leverage of B is higher than operating leverage of A, right? Because the portion of fixed cost out of total cost is higher in B rather than A, right? So the B's operating leverage, B operating leverage is higher than A operating leverage because the fixed cost, portion of fixed cost of total cost is higher in B. Then what happened if small sales decline? Then what happened in the profit? So if the quantity is decreased from the break-even point, just like this amount, this amount, this 1 unit, then profit, I mean the loss occur this amount, right? This amount, right? So if the quantity decrease, then we have this amount of loss in the graph A. Whereas in graph B, if the quantity decrease same as the A, then the amount of loss is this amount. In A, this amount. So B's loss, the amount of loss in B is much bigger than the amount of loss in A, because the fixed cost out of the total cost ratio in B is higher than A. In other words, operating leverage in B is higher than the operating leverage in A. So we would say B has the more business risk. Okay, B has the more business risk because the portion of fixed cost out of total cost is higher in B, right? That's the operating leverage. All right. Okay, let me stop here. So the next class we will talk about the financial risk. So as I told you, as I announced before, next Tuesday, you are supposed to, as I announced before, the next Tuesday, you are supposed to take the second quiz, and the homework of the second homework, the due date for the second homework is by the next Tuesday, okay? And the quiz has the two types, right? So three out of 5 questions are related to the review questions, and 2 out of 5 are the preview questions, right? So I'll let you know the range to cover in next Tuesday is till we will cover until here, before the theory. I'm not sure we can do that, but anyway, to prepare the final exam, you should know the chapter 15, right? So to prepare the quiz is also to prepare the final exam, okay? So the range to cover in the next Tuesday is till here, before the theory, capital structure theory. All right? Okay, Virginia, what kind of question?
Yes, because my book is an old version, right? So I have the exercises, but I think they are like not the same, or like at least they are not the same number. So I was wondering if you could post just like a picture of the page where the exercises are, so I know exactly the number and the exercise, and I don't make other exercise instead.
Okay, so what kind of version you have? Which version?
I don't know. Wait. Yeah, 2003. It's of 2003. So I don't know like the number of the version, but it's 2000.
Then anybody who gives the second homework to the Virginia here, your colleague, if the class is being conducted offline, then there's no problem, right? So your colleague is around you, so there's no problem. But this is the online class. So 준서, not 이준서, but 김준서.
Yes, Professor.
Yeah, you can give some the second homework to the Virginia.
Oh, okay.
무슨 말인지 알아?
그러니까
좀 번호가 다르대. 그러니까 그걸 해가지고 좀 보내줘.
올려주신 종이만 전해주면 되는 건가요?
종이가 아니라 이거 번호, 올려준 번호.
아, 책에 있는 핀트를.
끊어졌어. 올려준 번호. Okay, 정욱. Alright, thank you. 정욱 has the same problem of you, Virginia. So 정욱 has the copy of the second homework. So 정욱 will give you the second homework. Okay?
Okay, shall I give you my Kakao Talk, or because I don't know?
정욱 씨, 저 Virginia 이메일 알아요? 몰라? Okay. Then I will let you know the Virginia's email to the 정우. Okay? Okay, Virginia?
So you will contact me by email?
No. I will give your email address to 정우.
Oh, I see. Okay. Yeah, perfect. Thank you.
Okay. All right.
Thanks.
Any other question? Bye.